This is Robert Kraft, and I'm your host on SNN Network. And with me today is a really special guest. He's definitely made the rounds on all the financial media networks, and I'm just stoked that he took some time with us today to discuss and really try and make sense a little bit of everything that's going on. But without further ado, Meb Faber. He's the host of the Meb Faber podcast. Meb, great to see you, man. Thank you for joining me.
Hey, man, good to be back.
Great for you. I'm just so stoked that you took the time, man. So, let's start off. I think we should just dig right in. I mean, I just recently saw you on CNBC. You wrote this article on March 15th called Investing in the Time of Corona. So I really wanted to cover that because I think that's going to provide a lot of value for our listeners and really understand what's going on. So what's the thesis here? Tell us a little bit about the article itself.
Yeah, as we start a new decade, we've been talking for a long time about everyone has a different investing situation, but for the most part, as long as you have the basics, we like to talk about some global stocks, some global bonds, some global real assets like commodities or real estate. Most people have most of their money in the value of their home. Then the actual percentages don't matter, but it's really important to have a plan. And so it doesn't even matter what your plan is that much. We did a book called Global Asset Allocation that looked at all these different allocations and found out they all worked great as long as you kind of stuck with it, implemented it with low fees, didn't muck around. Well, the problem is that let's say you have your plan, you come into a year like this, and all of a sudden February and March happens. Every day feels like an entire year of a news cycle. It's exhausting. It's uncertain. The markets are going up 5-10% in a single day, up and down. And this volatility feels crazy. It's emotional. But had you spent the time doing the work, reading blog posts and books and podcasts and everything else, you would have understood that this volatility and movements are, quote, normal. It's still scary, but 5% days, they happen. They happen about 1% of all days. 10% days only happen about 0.1% of all the time, but they do happen. And they tend to cluster together, and they tend to cluster together when markets are already declining. That having been said, had you spent the time studying history, you realize that bear markets happen. We had two big ones in the U.S. since 2000 that lopped off half your money at one point. And so this one being pretty mild, I have no idea where the market closed, but let's call it down somewhere between 20 and 30% from the peak. That's pretty mild. And if you prepare for the worst, which would have been a 80% plus decline, which happened in the Great Depression, well, that's possible too. So the foundation is you had to have had a plan coming into this, because it's hard enough if you don't have a plan and you deal with something this emotional, it's almost nearly impossible to survive. If you have a plan, it's still pretty tough, because a lot of people envision in their head what their risk tolerance is, how much losses they can endure, and until they experience it, and particularly the younger crowd, for the first time, it's a very real physical, visceral pain watching your dollar, your account go down. So that's the base case. Now, so let's say you have all your ducks in line, you have a beautiful allocation, whatever it may be. We do it a little bit differently personally, where we do these Trinity portfolios where we do half in buy and hold allocations, half in trend following. Mm-hmm. And then you come into this period and all this is going on. And I could even make the case today that the world is so uncertain, you could come up with a bull case where you say, hey, look, the U.S. all of a sudden starts to do lots of testing. We align government, fiscal, monetary, and healthcare policies. Everyone self-quarantines except for the spring breakers in Florida. People take this very seriously. Tests are readily available. And it turns out, hey, maybe the malaria medicine actually works. And next thing you know, a month from now, 2 months from now, this crisis has abated. Markets romp up back to new highs. That's a plausible outcome. On the flip side, if you read the Imperial College report or look at what's happening, and the first one, by the way, the bull case is what's kind of happening in China and South Korea. They seem to start to be on the other side of this pandemic. But the bear case is you look at something like Italy, where it seems like it's totally overwhelmed the healthcare system. You could come up with a scenario where the U.S., it's gone exponential. You just don't know it yet. Hospitals get overrun. It continues on for months. maybe it goes away in the summer and we think we're all over it, and then right back again, it comes back in the fall, or maybe it's a mutated version and we all have to quarantine for another year. That's a very real possibility. In that case, you could make the argument. So we came into the year with U.S. stock markets trading at a P ratio of around 32, which is high, not bubble high, but high. We're down to around 23 now, which is still a little bit high, but way down, close to average, in my opinion, for low inflationary times. But if you go back to what happened at the bottom of the financial crisis, that's still 40% down from here. So the problem is you could make a pretty convincing article, and people do on Twitter and op-eds and on TV, of either of those scenarios happening. And so what's most likely to happen, probably something in the middle, but you have to be able to prepare for each. And the actual, as far as the portfolios go, the catalyst, the event, the geopolitics of what happened doesn't matter. You look back in history, it's world wars, it's other Spanish flus, anything that happened. In this case, the catalyst is the coronavirus. And so you have to have a portfolio where you'll survive either of those outcomes. We said on Twitter, the biggest compliment you can give someone in business investing is just surviving.
Yeah, I saw that.
So is your portfolio balanced to the point where you focus on the main likely outcome, but the outliers are still possible and you can survive those? That's the foundation. And I think that's important. And to be able to think through that, those possibilities at least helps prepare if one of them happens.
So is it too late because let's say we have people that, listen, I have friends who never pay attention to the stock market, maybe don't even really prepare, are good money managers, even just save, okay, maybe too late is a bit of a dire question, but let's flip that around. Is there anything that they could do right now, maybe if they hadn't prepared in the way in which that you're saying that you probably should have prepared for times like these?
Well, look, you're young. Let's say you have a pretty young audience. The interesting part, and we said this on Twitter the other day too, because it's one of my favorite investing quotes, is investing is the only business where when things go on sale, everyone runs out of the store. So if you're under the age of, 50, and you're still contributing, and the younger you are, the better it is, 40, 30. If you're 20, the best possible thing you could ever see in investing is the stock markets crater and go way down and get super cheap, because then you have a lifetime of saving and allocating when the markets are cheap. You got to be careful the way you phrase this. It's not that you cheer for bear markets as a young person or want them to go down 80%, but it sets the stage for an incredible future. The problem is most people have it backwards. They want to allocate less the more it goes down and more the more it goes up, because they tend to get caught up in the sort of envy and buying what they wish they had bought. So I had some friends reach out and say, hey, Meb, I got a 401k, I got a retirement. Should I continue contributing? I said, not only should you continue contributing, you should try to max it out as much as possible, but that should also be part of the plan where every month, I'll give you a good example. I put 100% of my 401k each month into emerging markets. So the U.S. valuation, we said, started the year 32, is probably around 23 now. Foreign developed started the year around 22, is probably 15 now. Emerging markets started around 15 or probably around 10. Wow. Some of the really cheap stuff is probably mid-single digits P ratio, like the Russias of the world, if not lower. And it may not be today, it may not be this month, it may not be this quarter, it may not be this year, but that is a generational buying opportunity. If you can buy investments at under these P ratios of 13, even under 10, some around 5, you want to be doing that other day. The struggle that most people, they want to think in terms of all in, all out, or binary. Should I be buying today? Whereas the real question is, should I be allocating some? Should I be trimming? Should I be allocating a little bit? Should I have a plan to where I'm auto investing every month? And so particularly for the young people, how much you save in the first place and how much you decide to invest swamps, and it's not even close, your investing returns. An example we gave in one of the articles we did called the Get Rich Portfolio. if you can invest at 10% per year, in 25 years, you 10x your money, and 50, you 100x it. Not 100%, 100x. So you put in 10 grand when you're 20, that's $1 million in retirement. And so someone who's 20 that only contributes $40 a year for 10 years, you end up with $1 million retirement. You only started with 20 grand at some point over the course of just one decade. So I'm trying to impress upon, if you're a young person, it doesn't really matter. It's kind of a rounding error. And you should be more interested to invest the more markets go down. But also try to come up with a plan too, because that makes life a lot easier, and automating it.
Yeah, that's for sure. And this one's really for all our audience, for all age groups. What right now in these really volatile markets, what are some of the things that investors should really look out for in your opinion? Should they look out for those companies that are putting out those press releases that, new vaccine developing for coronavirus, because we've been seeing a ton of that stuff going out there, especially in small micro nano cap land. And some of it's real. I'm hoping all of it's real, because we need more of it out there. But some we don't know, especially in terms of time frames and how that works out. But that's just one example. Are there other things that all investors should look out for if they're looking to deploy capital right now?
Hopefully ignore it all. The biggest challenge with the news flow is 99.99 is noise, right? And if it's not noise, by the time it's getting to you, it's widely acknowledged and accepted. So the only way to really generate outsized returns as an investor is you need to have data that other people don't have. You need to have an insight or a model that other people don't have, or you need to be able to arbitrage an opportunity that other people won't. So the ability to think in long term, I think, is actually one of them. So for most of it, it's actually ignore it, because depending on who you follow on Twitter and Facebook, you're going to get a very bubbly, different view of the world than someone else. And so if you follow a bunch of doomsdayers, you may end up thinking that the S&P is going to zero and all these companies are going out of business. If you follow a bunch of entrepreneurs and scientists, you may have the opposite view. So, that to me is why trying to quantify it or make it rules-based makes life so much easier. That's not for everyone, though. And so I like to think in terms of this recommendation. Come up with whatever your portfolio may be. A great example for most people is the global market portfolio. If you bought every public asset in the entire world, you end up roughly half in stocks, half in bonds. Of that, half in the U.S. and half foreign. That's a great portfolio, right? That does fantastic over time. And use that as your ballast. So you start to tilt. So as a value investor, you may tilt towards emerging markets or the cheapest countries in the world. And when I say tilt, I don't mean going from, if you're 50 stocks, 50% bonds, to 90% and 10. You may go 55% and 45, right? So it's something that's just, we did a couple podcasts with Howard Marks and Rob Arnott where they talk about over rebalancing or calibrating or tilting. So many investors want to think in binary terms. Should I be in stocks? Should I be out of stocks? Is it the right time to buy Bitcoin? Should I be selling it, in or out of gold? And we always tell people the best behavioral hack, and this is highly technical, so apologies, is to go halvesies, right? Don't feel like you have to be all in or all out. Just go in the middle. In that case, that way you'll be half wrong no matter what, or half right no matter what. And so there's some other opportunities if you want to get a little wonky and esoteric that we mentioned. One is any industries that are down like 80, 90%. Most of our research shows that if you close your eyes, hold your nose, and buy some of these and hold them for 3 to 5 years, you usually have pretty great returns, because they're just totally hated, throwing the baby out with the bathwater, blood in the streets, disgusting. No financial advisor, no professional investor wants to have on their books something that already has gone down 80%, because people look at it and say, what an idiot. So you can pick up some of those things for some rebound potential. And then there's a class of funds out there called closed-end funds. And if you go to a website called Closed End Fund Connect, you can see that they actually will trade pretty far away from their net asset value. Some of them will get 20, 30, 40, 50% or more away from their value. You got to be a little careful because they tend to be more expensive, tax efficient. Some of them have leverage, but it can be an opportunity. They're not particularly liquid. So you could buy a little bit of some of these and hold them for a few years and hopefully realize that premium compression, discount compression over time. But again, those are things you can kind of do to feel like you're doing something, maybe to add a little bit of value, but also to avoid mucking around with the main anchor, which is the good portfolio design in the first place. And make sure that you implement this, by the way, thoughtfully with low fees. For us, that's a basket of ETFs. You can buy a basket of ETFs that track these for zero cost today, essentially, or very low cost. There's a lot of automated rebalancing robo-advisors as well. Vanguard does it. It's a really great offering too.
Gotcha. And one final question. I know you gave both the extreme bull or not extreme, but the possible bull, possible bear scenario, really at far ends of the extremes. So I have to ask, won't take your word for it. And I guess you're technically you're not on the record, right? Not on the record of, what do you think might actually happen over the next, 3 to 6 months?
How about I give you the next decade?
Okay, decade.
So remember, the caveat to this is I'm a quant. So this is called a happy hour discussion, cocktail hour. So it's just gossip. I'm on the bullish side. We have the experience of the rest of the world, particularly in the U.S., that we got to see the playbook for better and worse. Sadly, we got to see how bad it's continuing to go in Italy, and hopefully people take it very seriously. I think there's some promising signs on treatments, as well as I noticed somebody on Twitter was saying that there's a company that's going to start sending out at-home diagnostic kits for testing on Monday.
Yep.
So things you can see the shoots of grass in a good sense. Does that mean markets have to go up? It doesn't, right? They may, but it doesn't necessarily. Some of the problems this will have created will probably have some lasting effects. If you were to say, Meb, what's your 2020s forecast? That's a lot easier for me because I think we can get it actually pretty close to right. Going into this year, we were saying U.S. stocks would have pretty close to a 0 to 2% return for the next decade. Even Vanguard said it wasn't much higher than that. I think they said 4%. We're probably up to now closer to like 5%. So hooray. Bonds essentially are almost zero. And so they're pricing in a total deflationary environment. You're going to get 1% on your bonds for the next decade, which is not particularly attractive. But the good news is foreign stocks should do 10% from here per year for the next decade. And foreign emerging, I think it probably gets you to 12 to 15%, along with the really cheapest countries in the world, if you're willing to hold them for the long haul. And bonds in the rest of the world are not particularly interesting either, with the exception of the sovereign high yield bonds, which I think probably are yielding up 6-7% at this point, maybe 8% after yesterday. But again, that's not really a risk off diversifier. So I think a balanced portfolio is getting back up, particularly if you do it heavy allocation to value or foreign, back up to the traditional 7-8% returns. You got to be a little weird and different. I think one of the biggest opportunities I've neglected to mention is one of our favorite tilts, which is a tilt towards value. And so value has not been helpful really at all for a long time. Small cap value in the U.S. is down about 40% this year alone. So over time, I think if I had to name one asset class, it's probably emerging markets value that would probably be the best over the next decade. Next 3 months, I'll give you a band. It's somewhere between -90 and up 100. That's my high confidence band, somewhere in there. But a good comment on that is that going into the year, this is, by the way, this is what you get with me is a 20-minute answer to your 1-minute question. Going into the year, all the Wall Street strategists, I think, were within a band of 11% to -3. And the funny thing is that we were talking about normal market returns earlier, is that 80% of traditional yearly returns fall out of that range. They're either worse than -3 or better than 10. And that's just because normal market returns are extreme. So I said a simple way, if I was going to be a forecaster, is to go into these contests and just name some outlandish number, -20 or +20, and you would win more than anyone else would on a consistent basis. So bullish on the future, particularly with tilts towards value, foreign, emerging. And in the next 6 months, I'm optimistic, but that's by nature.
So with that, Meb, where can my audience go and find more information about you and can go subscribe to your podcast?
Yeah, so my day job is at Cambria. We run 11 ETFs, asset management company. It's Cambria Funds or Cambria Investments. We put out a lot of free content, so you can find it there or at my blog, mebfaber.com. I have over 2,000 blog posts, 200 podcasts, 5 books, most of which you can download for free, a dozen white papers as well, and watch me pick fights on Twitter at Meb Faber.
Dude, thank you again for joining me, man. I really do appreciate you taking the time, and stay safe.
No problem. It's been a lot of fun. You as well.
Thank you.